When you're buying a tax lien, your goal should be to buy it 25 to 30 cents of the retail value. I've had situations where after waiting a year and you pop open the door and see that it's ready to go and you can sell it for retail value without doing hardly anything.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Point Central, the leading provider of enterprise-scale smart home automation for short and long-term rental property managers. Learn more at pointcentral.com. Hello and welcome to episode 99. My guest today is Hunter Carlile. He's the president and owner of Tax Lien Investors out of Northern Indiana. Today we're going to be talking about Hunter's tax lien investing strategies, as well as his investments in finding distressed properties, fixing them up, and either holding them as rentals or wholesaling them. Hunter's been doing this for 14 years, and for the past 4 years, he's been doing it full-time in Northern Indiana. So Hunter, welcome to the show.
Thanks for having me today.
So we're going to be talking about tax lien investing, and I think this is going to be a fascinating topic. Before we go there, though, I want to know a little bit more about you and how you got started investing in real estate.
Wonderful. My introduction to real estate was about 14 years ago. I bought a foreclosed property and thought I paid too much at the time, but still own it today as a rental property and have never looked back as far as the opportunity in real estate.
What got you interested in buying that property in the first place?
After touring it as a foreclosed property, I saw that you could buy it right and put some paint and carpet in it and make a huge difference and be able to either keep it as a rental or sell it. And I've chosen to keep several as rentals just to have that annuity-like income.
And was this like just that initial property? Did you buy it because you'd read a book, because you took a seminar, or did the idea just pop in your head, hey, here's a foreclosed property, why don't I buy it?
I wasn't smart enough to do either of those. I just took the opportunity and saw that there was money to be made, had some friends that had dabbled in it a little bit, but paid $5,000 for the property and thought it was well worth the risk. And today that same property pays over $800 a month, and I still own it 14 years later.
Wow, you own it free and clear.
Free and clear.
And what's it worth now?
Probably $80,000 easily.
Not a bad investment.
No.
Huh? So did you just kind of follow that formula in the beginning? Just buy foreclosed properties, maybe fix them up, and then rent them out?
Correct.
And how many of those were you doing?
When I was doing it on the side, I probably had as many as 12 rentals at that point. Then kind of got busy with life and sold the rentals, fortunately, in the early 2000s before things went crazy. After the market crashed, my career changed a little bit, and I saw an opportunity to buy properties again at a discount after the crash and through some strategies that we'll talk about later, but have never looked back. I've probably purchased over 200 properties at this point.
Wow. So your strategy is to purchase distressed properties. Where and how are you finding these distressed properties?
Well, after all the success of the home flipping shows, became harder to buy foreclosures, even in rural Indiana. So I had to find other means. I'm a home investors franchisee, and through direct mail advertising, we buy distressed properties, but also learned a little bit about tax lien investing. And by no means am I an expert in tax lien investing, but I found it a wonderful way to buy properties at a deep discount. Now, granted, you have to hold them a little while, allowing the owners time to redeem them And if they do so, you receive a premium interest rate. And about a third of those cases, they do not redeem them for whatever reason, and you receive the deeds to the properties.
So I want to back up on the tax lien investing and really dig into that here. Before we do, you mentioned homevestors. And some people are familiar with that, some people aren't. But that's a franchise that helps you find, like, basically gives you kind of a pipeline of distressed properties. Is that kind of what homevestors is?
Great organization out of Dallas, Texas, started by Ken D'Angelo. I think it's been 25 years ago now. Company-wide, we've bought over 70,000 homes.
Wow, 70,000 homes. And it's are you marketing through the internet or bandit signs, or how does homevestors find the distressed houses that they're picking up?
Primary form of advertising has been very successful, just direct mailing to property owners. And we can drill it down by zip codes, number of bedrooms, things of that nature.
So, and I'm sure that a lot of our listeners, including myself, have received those mailings if you own rental property or any type of property from homevestors. So I know exactly what you're talking about. But that those direct mailings seem to yield pretty good results.
Surprisingly so. I've been amazed.
Now let's talk about tax lien investing. And this is not something I think we've really discussed on the show. So I want to kind of just start with the basics. First of all, what is tax lien investing?
Well, as you know, we all pay property taxes to fund ambulances, fire trucks, schools, things of that nature. And when those property taxes go delinquent, municipalities cannot fund those entities properly. So in each state's a little bit different. I will only speak to Indiana, but I've done a little research in Michigan, and they still have property tax sales. It's a little more cumbersome, I guess, in Michigan than Indiana. But to your point, when those properties go to public auction, which is once a year in Indiana, the property owner has received several notices well in advance saying you need to pay this before the date of the auction.
So they haven't paid their property tax. Maybe they owe $1,000, maybe they owe $20,000. But the city's going to foreclose on them, huh?
Correct. And in Indiana, they're delinquent 3 pay periods. So spring, fall, and then a spring, we'll have them in the sale that fall.
Okay.
They are notified by the municipality well in advance of the sale that they are delinquent, and if they do not pay those property taxes, their property will be subject to the auction. But even after the auction, assuming the property sells, they have 1 year to redeem that property for a penalty.
So you're buying their tax lien.
Correct.
And sounds like it can take up to a year for you to see any return on your investment.
Actually, it's 1 year for them to redeem. Then it's about another 60 days by the time we actually receive deeds to the property and can do anything to them. For that 14 months, we can't do a thing.
Are you receiving any income in those 14 months? Are they paying down what they owe in some cases?
In some cases, the properties are redeemed, and actually 2/3 of the cases, they redeem the property, and we receive an interest rate in exchange for our money. In Indiana, on the basic bid, if they pay it back in the first 6 months, it's 10% interest. If it's in the latter 6 months, it's 15%. So it's a premium interest rate, but for 1 year of redemption period and 2 years for the legal side of it, we do not receive anything back on the properties that are not redeemed.
So are you buying the tax lien at face value, or are you getting any sort of discount on it from the municipality?
Basically, the opening bid is what is owed to the municipality. And no, there's no discount. It's a public auction. Highest bid wins.
So it really seems with this type of investing, the minimum return you're going to get is 10%.
Correct.
Because if the owner redeems or pays off what they owe, they're going to pay you that 10%. Do you have any other costs out of your pocket that eat into that?
There's legal notification that we are reimbursed for. And for the owner to redeem that property, they do have to, as long as we file it properly with the treasurer, we do receive that back. And each county is a little different. The cost of legal and notification can be anywhere from a $500 fee to $1,000.
Basically, that cost is covered by the homeowner when they pay off. So any out-of-pocket expenses to you are added on to what the homeowner owes.
Correct.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. Okay, so the minimum amount you're going to get is 10%. In the back 6 months, you're up to 15%. So is that sort of blended for the year, like a 12.5% return that you would get?
Again, the law says that that's on the minimum bid. If you bid above and beyond, the municipality only pays 5% for what's called surplus. So you have an opening bid of $1,000 and the public auction takes the value of that lien to $5,000. $4,000 is called surplus, and you only receive 5% on that. But my average for 4 years of doing this is you can expect to receive 10, 11% on your redeemed money.
Okay.
Now, the real money is when you receive deeds to the property.
Yeah, so let's talk about that now, because, in how many instances, in your experience, how many instances does the homeowner come up with the money to pay their taxes?
About 2/3 of the cases, the homeowner will redeem it.
2/3 of the cases. So 1/3 of the time, you're actually going to then do a tax foreclosure?
In Indiana, it's called public auction, and then you receive a tax deed. Versus foreclosure, I typically think of a bank foreclosing on a mortgage.
So you would receive a tax deed, which then gives you title to the home?
Correct. And that tax deed is superior to all other liens and judgments against the property. So if the homeowner does not redeem it and you receive that deed, it is washed of all judgments, mortgages, any blemishes come off at that point.
Yeah, so that's a big deal, because if there's a mortgage on that home, then that mortgage just gets washed away.
Correct. Had that exact situation about 4 years ago where a bank held a $75,000 mortgage on the property, and I purchased the lien for $5,000 and change. Well, the bank had been bought and sold several times over that year of redemption. We gave proper notification to where the treasurer had the owner's address listed throughout that year. And this is all done by an attorney so that it's done properly.
It's all above board and
all
legal
above board.
And documented.
Yep. Mm-hmm. And I'll finish the story by saying that the bank objected to us receiving the deed. So our attorney went in and stated his case, showed the certified letters that went to the proper address. And again, this bank had sold repeatedly, as we're seeing in today's times. And the judge said, well, you didn't update your records with the local treasurer, and they mailed to the proper address on file. At the end of the day, we received the tax deed to that property.
Wow. So let's focus on that specific instance. So the bank had a $75,000 mortgage on it. You bought the tax lien and then ended up with the tax deed for $5,000.
Correct.
What was that home worth?
It was not in the condition it was in. It was by no means worth $75,000. But when
so it was already underwater.
It was underwater, but easily worth $50,000 with a few repairs.
And what did you do in that specific instance with that? Did you, like, obviously you can take over the home, sell it, make 10 times your money.
Well, in this particular situation, we went to the homeowners well in advance of the court hearing even and said, we'd like you to stay if you choose to. Otherwise, we're aware of this court hearing and sure you're aware of it. If not, you need to be aware of it because the bank has been escrowing your taxes and they have not been paying them. So it got a little more complicated.
It was actually the bank's fault.
Absolutely.
That the property taxes weren't paid.
Correct.
So that's an interesting wrinkle because a lot of people have the bank escrow their taxes and insurance, and if the bank is not paying that, they may not even realize they're going into foreclosure.
Yep.
So what did these people say?
These people obviously were a little standoffish at first because they were not aware of the pending foreclosure. But I'm going to say foreclosure, but I really mean public auction. So we went through the objection period with them, and they were notified by the bank and the attorney that they were not successful in objecting to this and that we were the new owners of the property. So I went back and met with them and made them the same offer that you can stay, we'll do a rent to own, or keep you just as a tenant. And they chose to stay as a tenant because they saw an opportunity to move on a year later. But they rented it for $500 and change a month. And we were in the black in the first year. They took a job opportunity out west. And ironically, their daughter decided she wanted to rent it and is still there today.
So you're holding it and just renting it out, huh?
Correct.
Wow. She's still paying $500?
A little more now.
Let's talk for a moment about Point Central, the leading provider of enterprise-scale smart home automation for short and long-term rental property managers, and how their exciting technology can help you control property access to vendors and potential tenants. No more time wasted waiting for late appointments or no-shows. Oversee energy usage and analyze data in order to reduce utility and maintenance expenses. Eliminate the cost of keys or rekeying locks. Command higher rents and increase tenant retention, and provide tools for tenants and managers to monitor the property to improve safety and security. And it's all done through cloud technology, utilizing encrypted data and private cellular service. And best of all, the return on investment of installing Point Central's technology is upwards of 25% a year. The future of property management is here, and you can find out more by visiting pointcentral.com. This whole thing about the bank not paying, they're escrowing the money for property taxes and insurance, and then they're not paying that. But yet the people living there thought that it was all being covered. They were living up to their end of the bargain, paying their mortgage, paying their escrow. That seems like such a violation of trust.
Absolutely.
And that is why, and that's one of the reasons why, if I have any opportunity on any of my loans, I would much prefer not to have those amounts escrowed by the bank because I do not trust banks to get it right. And I've had an instance myself on a property I owned in North Carolina. I've since sold it, but I was paying my escrows, taxes and insurance, and year and a half in, somehow came to realize that they were paying the property taxes. only it wasn't for my property. It was for a different property they held a loan on. So my property taxes had gone unpaid. So you can imagine how upset I was. I mean, luckily I didn't lose the property in tax foreclosure, but I was sure upset that they had escrowed my money and not paid the bills.
It happens more times than you would believe. I mean, I'm a small tax lien buyer in Indiana, and I've had 10 or 12 situations where the bank was not doing what the homeowner contractually expected.
You're able to pick these up. You have to wait 12 months plus another 60 days. And then what is your normal operating procedure on the 1/3 of these properties where the homeowner or the lender does not come in and pay the back taxes? What is your normal operating procedure then?
Well, once all the proper notification is complete legally, we receive a deed to the property. Now, most of these properties are vacant because the homeowner is well aware of the situation. Now, in some cases, there'll be people living there, and we will go knock on the door, introduce ourselves, say, I'm sure you're aware. Now, half the times they say they're a tenant and not aware, and we always try to keep them in the property as tenants, but make it very clear to them that whatever relationship they had with the prior landlord is gone. Therefore, they need to pay in a timely manner and give them the opportunity to prove themselves versus just simply going through the eviction hearing and starting over. My goal is obviously to get it cash positive as quickly as possible. And if somebody's in there that's willing to pay, I'd rather just keep them there.
In your experience, how often are you able to keep people in the home?
Oh, it's better than 50%. I had a situation in Elkhart where lady was aware of the foreclosure. I keep saying foreclosure after you brought it up.
Yeah, sorry,
of
planted
the
that in your mind there.
Tax lien notification, and was dealing with some mental illness, and told me quite frankly she had just neglected the letters. And when I arrived upon receiving the deed, I said, I'd like for you to stay. And this is 4 years ago. Helped her get some surplus back from the county as a down payment on the property. And she pays $525 a month for the last 4 years, just like clockwork. So those are the stories that make you feel good because she's so happy to have a second chance.
What about the other 50% of the cases?
The other 50% have either left well in advance of us receiving a deed because they are properly notified, or we quickly learn that they're not going to pay rent and weren't paying rent before and have to go through the eviction process there.
And how long does that eviction process take?
In Indiana, it takes about 3 weeks.
Okay, so that's pretty quick.
Yeah.
So you've obviously been through some evictions. I mean, is that something that's normal and routine?
Certainly don't like having to go that route. We've given them every opportunity to make good, but at the end of the day, they can't stay there for free. So it's no fun, but I have an attorney file all the paperwork, and once they're notified and go through the court hearing, if they still choose not to leave, the sheriff comes out and gives them 15 or 20 minutes to exit and go from there.
Now, are you the one who contacts the homeowners or the people residing in the home? Or do you have a team that you work with that does a lot of this?
Just to be clear, are you talking through the tax lien process or once we receive deeds?
Once you receive deeds.
I like being involved in that. I do have a team of people and never go by myself on those calls, but I like being there to talk to them.
Yeah, so I'm interested in that because there's definitely a certain amount of finesse and psychology involved in those conversations. How do you approach them?
Well, just try to be open and honest with them, and most importantly, try to make them admit that they're aware of the tax lien notifications to kind of make ourselves look a little brighter in their eyes as we truly would like them to stay there and pay rent on that property.
Do you meet with a lot of denial on these people's parts?
In some situations, the lady I referred to with the medical illness was in denial at first, but after we talked for 10 or 15 minutes and she witnessed that we were there to work with her, she was pleased that we were there and she had a second chance.
How long does it take you to gain trust with the people you're talking with, and how do you gain that trust?
Well, I think you only have a few minutes to make a first impression with them, and when they are in denial, it's harder to do. But I try to be just very frank with them, and you have one opportunity to stay here, and I'm willing to work with you, but we will have a rental agreement and caveats laid out that you need to meet on a monthly basis. If not, you're going to force me to go to the next step. But most importantly, my first goal is to get them to stay long term.
And does that really boil down to you just saying, well, you were paying $500 a month, we expect you to continue paying $500 a month? Is that at its essence what it boils down to?
That's what it boils down to. And I've had situations where the property might be worth $600 a month, but if they can show me a rental agreement or some sort of contractual obligation that they were paying $400, I tell them I'll live with it for the first year as long as they live up to their side.
Okay. So in those conversations, you said 50% of those conversations end with the person staying in the home. The other 50% end in some sort of eviction. Of the 50% where the people agree to the terms, do a lot of them live by those terms and follow through on it?
A surprising high number. I can't give you the exact ratio off the top of my head, but being a landlord, as you know, there are some people that are going to move every few years, but for the most part, if you're good to them, they're good to you. Now, we all have difficulties financially, and I've always tried to work with them as long as they're communicating.
Give me an example of a difficult situation where you were dealing with someone who you couldn't come to terms with.
I've heard every story in the book. I used to have a mini storage business as well, and you'd hear that somebody passed away or somebody left their spouse. The hard ones are when kids are sick and things of that nature, and you try to give them the benefit of the doubt on the first pass. When they don't follow through and do what they say, obviously you have to be a little more stern.
So Hunter, you have a company called Tax Lien Investors. Does that involve working with other investors or training other investors on how to do this?
Yes. Over the last few years, friends and acquaintances would ask to learn more about tax lien investing. And my wife and I were talking one night, and she joked, you should start a company to train people of how to invest in tax liens. And we kicked it around for a little bit, teamed up with a marketing company, and also developed some software that helps streamline the research process, because the real key to successful tax lien investing is doing your homework. I've certainly made some mistakes in my career and thought I was buying one thing and ended up with something else. But if you do your homework, that's the key. And the software that we've developed helps eliminate a lot of computer time in researching these properties.
What does the software allow you to do?
Well, when I first started doing this, our research was twofold. One, you'd print the list from the municipality, and if the minimum bid was crazy, we'd take it off our list because we assumed it was a knockdown. If the assessed values were within single family parameters that we felt comfortable in, we would research it through the municipality's GIS website, to confirm the assessed tax value. In some counties, they will show you a picture of the property, number of bedrooms, things of that nature, just so you can see it as truly a house. The next step of that, in some instances, depending on the county, you had to go to 3 or 4 different websites to find that information. What we have created is a software that allows you to download the municipality's spreadsheet of tax liens and simply have access to the scorecard or property report card, some counties call it, as well as Zillow and Google Maps, all at one click, versus when I first started doing it, we were going to 3 different websites to get all that information. Now, I made reference to being a twofold process. Once we identified the targets, we go and drive by each address. We'll route ourselves through a mapping software, and we might drive 200 properties in a given day, confirming address, condition of the roof, whether or not it has a gas meter, get a look at the foundation. And to be able to do 200 properties in the day, you're literally in front of that property for 5 or 10 seconds.
So you're not getting out and walking the property. You're just looking at it from the road.
Again, you're trespassing because at this point, we don't even have a lien on the property, more or less a deed to it. So you're making a judgment call. And in light of that, you're able to buy these properties at a discount because we cannot see the inside. But you get to know pretty quickly that if it's vacant, occupied, if there's no gas meter, you know it's been vacant for a year plus. If the roof's curling, you know that a year from now it's going to be worse. And most likely you're going to have leaking inside the property over the year that you wait for it to be redeemed.
You're looking at 200 properties. Are they all within a certain mile radius of you, or are you going way out there to find these properties?
In the bigger cities, Fort Wayne, South Bend, Indianapolis, they're all relatively close. You might have 2 on within a quarter of a mile kind of thing. So you can do 200 properties a day. And that was just a per day account. Like in Allen County, we just finished that up and we drove over 500 properties in about 2.5 days.
Wow. So you're teaching other people how to do this. Are you also investing on other people's behalf?
I do represent a handful of investors that like the annuity-like income of tax lien investing and the security of it, quite honestly.
Yeah, I mean, it seems like you're going to get your money one way or the other, as long as you're doing the research.
As long as you do your homework, it's
what are, for those who aren't experienced like you in doing this, what are some of the pitfalls that people would need to be aware of?
The big one is in the larger cities, or many larger cities have blight programs right now where they are buying back properties and knocking them down. It'll be in areas where they have a high number of police calls to those areas, and for public nuisance security measures, they will buy a property either from the homeowner or the tax lien investor and knock it down. Well, that happens so frequently that the GIS websites or Google Earth, whatever the case may be, those pictures might only be updated every few years. So that's the reason that you actually have to drive it, see a physical address, and
to make sure the city hasn't torn it down already.
Yep. And as I stated, we just wrapped up Allen County, which is Fort Wayne, Indiana. Of those 500 properties we drove, 2 of them used to be homes. They were flattened.
If you buy the lien and tax foreclosure, then is there any recourse if the property's not actually there?
There really isn't. It's a buyer beware sale. Now, there are strategies. Let's say you, at the end of the year, you want to go back. I always do go back and make sure that that house is still there then and worth what I had bid on the lien. Now, if that is not the case, and I had a situation where a house had caught fire over the given year, I was able to go back and self-redeem that property, which is a legal process to get my money back because there was surplus. Now, if there was not surplus, I would have had to eat that mistake.
Have you ever lost money doing the tax liens?
Knock on wood, no. But I haven't. I mean, there have been situations where I bought a property that I may have wished I hadn't paid as much for it, but we've been able to come out profitably in all of them.
Is that another? Because I'd imagine if you're buying these tax liens, you want to have some understanding of the value of the property you're buying. If you had to sell it on, wholesale it or sell it on the open market, do you just know these areas well enough that you can look at them now and say, well, that's going to be 60, 70,000 or 80,000?
You're 100% correct, and it's part of doing your homework, making sure you know the retail value of these properties. My goal is to never bid more than 25, 30 cents on the retail dollar, because again, we don't see the inside of these houses the day we go to auction. So our average tax lien purchase is less than $10,000.
And then you have students then that you're teaching how to do this?
I've just started Tax Lien Investors to teach people the process and the ins and outs of this. We will have a seminar next fall prior to the Indiana sales. So we're just out promoting it and getting ready for it. But in addition to the hands-on side of it, I've developed this software that helps streamline the research process that is part of the package.
And do you sell the software outside of the package as well?
We're not quite there yet, but yes, that's our long-term plan.
So you're doing the coaching and the mentoring. It also sounds like you're working with investors who might want to invest through you to do these tax liens as well.
Correct.
I always like stories, and you've done so many deals. I'm sure you've probably got a good horror story and probably a great success story. So why don't we start with a good success story?
Probably one of my favorite stories, when you're buying a tax lien, your goal should be to buy it 25 to 30 cents of the retail value. Now, I've had situations where former owner may have deceased, bank owned the property, things like that, where literally we open the door and you don't quite know what to expect, but it's always very gratifying to open the door and see a house that is well taken care of, and you can turn around and sell very lucratively and quickly. And we've had quite a few of those stories that after waiting a year and you pop open the door and see that it's ready to go and you can sell it for retail value without doing hardly anything.
What's the best return you've gotten on those types of deals?
We've had 400% and 500% returns in those stories.
Wow, nice.
Not bad. Yeah. But again, the key is doing your homework, because we will drive hundreds and hundreds of properties and end up buying 75 to 100 liens in a given county, to have 2/3 of them redeem, and the third you do keep. Each year we'll get a couple, 3 of those out of it, and the rest need work, and you deal with neighborhood code on some of them. So it's not all cherries, but the ones that are certainly make it worthwhile.
Yeah, you're putting in the effort and the legwork. How many auctions do you do a year?
This year we just did 2 due to the dates and how they fell, but we've done as many as 8 Indiana auctions.
How many of these tax liens are you buying in a year then?
Last year we bought over 100 liens. I mean, we're beyond the redemption period. We're in the legal waiting period, and we will receive 35 houses out of that. 1/3 will be deeded.
That's pretty good. So 1/3 will be deeded. That's
Yep.
right where you said it would be. Any horror stories?
First year of tax lien vesting, when you're driving a couple hundred properties a day, your eyes are weary. And there was a street in Fort Wayne where we bought a $3,000 lien and really thought it was a house. And I believe that it was at the time, but over that year, I think the city knocked it down. And in that scenario, we did not have any surplus. So I could not correct the mistake and self-redeem it. So I ate $3,000 of what was a house and moved on. In that particular case, I never accepted the deed. It's still in the former owner's name because I didn't want the responsibility of mowing it, and an inner city lot, you're not going to have much luck selling it. So I made the decision not to take the deed and just bite the bullet.
So you had to write off $3,000 on that. And then you have so even though you bought the deed in tax lien foreclosure, you don't have to accept the deed.
You do not have to accept the deed.
So
legally.
ultimately, you do not have to take on the liability of that home,
No,
or that lot.
And you bring up a good point that we haven't gotten to. There are a lot of institutions, banks, insurance companies that you will see at these auctions buying the higher end properties. They don't want the single family, but when they're commercial, delinquent taxes, and even higher end single family homes, they will be there to reap the benefit of the high interest rate. And at the end of the day, they will go self-redeem these properties because they're not in the real estate business. They want their premium interest rate, not the property.
So at the end of the day, you say they won't redeem
They will self-redeem it, so they get their money back plus their interest rate. Mm-hmm. And that homeowner, or whatever the case may be, keeps the property. They just got really lucky.
Wow, that would be really lucky.
The banks and insurance companies need the security of real estate and tax lien investing to offset their losses when we file an insurance claim or pay us interest at the bank. So it's kind of interesting, all the different facets that tax lien investing
is there any market out there then for banks that do that end up not redeeming, that you can pick that property up from them?
I think there certainly is, but I have chosen just to stay in the $8,000 to $10,000 tax lien per property. That ties up a lot of money because they're only bidding on commercial and high-end stuff.
So it seems like you really need to have an understanding and some experience in doing this to get it right. Have you seen people novice investors make mistakes when buying these tax liens?
Yes. Just a week ago, I was picking up my liens following the sale in Fort Wayne, and I asked the gentleman who manages it, did anybody make a mistake in bidding? And he said, yeah, we had 3 of them where the folks were objecting to the process. The one that I thought was most interesting, and it goes back to what we said earlier about doing your homework and being prepared. There were 2 parcels for sale. One was a farmhouse with 3 acres, and the other was 50 acres of farmland. Well, the gentleman thought he was bidding on the farmland because it was the first sale of the auction, or earlier in the auction. And he came out of the gates and opened the bid up at $50,000. Well, nobody bid him beyond that. The opening bid was like $10,000, and he jumped it right to $50 to make a statement. And in reality, he's now the lien holder on a farmhouse, not farmland.
Oh, he got the farmhouse and a couple acres and not the 50 acres.
Yep.
He got a little overeager there, huh?
Yeah.
Oh, ouch. That's an expensive mistake. So then the 50 acres, did that go to someone else?
That went to another bidder. I don't know for how much, but
probably a lot less than the 50,000 statement that was made earlier. So you see that happen, people making mistakes in the bid, either because they're just too eager or maybe just inexperienced.
Yeah, and you just need to do your homework and your research and make sure you know what you're bidding on and drive by them to confirm that they're there. Yeah. Crazy things happen. I'll have in my research notes that it's a torn down house and an opening bid of $1,000, but it still lists the address. So people who have not done their research or just make a mistake will start bidding on that, and they might go up to $5,000 or whatever their high-end bid is, only to realize when the redemption period's over, they've going to receive tax deed to a vacant lot versus an actual house. So,
But they're out that $5,000.
yes.
Ouch.
Now, it's less likely with the low-end properties, but there is something called self-redemption as long as there's surplus dollars, meaning the bid went beyond the opening bid, that you can go back and self-redeem it and get your money back. And after the interest, it's basically a wash depending on what the opening bid was. But certainly, if that's the case, better to do that than get stuck with a $5,000 vacant lot in the inner city.
Well, for those who are listening to this and are very interested in tax lien investing, what advice would you have for them as far as getting started in this field?
Well, let me take the opportunity to promote taxlienvestors.com. Also, like us on Facebook. Feel free to contact Hunter at taxlienvestors.com. Hunter at taxlienvestors.com.
And spell that, because Lien is Lien?
Yes, it's TAXLIENVESTORS. We will be publishing dates of our next seminar, which won't be until late summer, early fall next year, depending on when the Indiana counties hold their auctions. Our program will start 2 days before the auction. It will involve classroom education, as well as we will go drive properties. We'll all get in a bus and drive individual properties so you can learn what to look for and what to watch out for. Then hands-on training at the auction is the third day. So again, watch our website and Facebook to join us. It'll either be August or September next year, and learn about tax lien investing.
Great. Well, Hunter, this has been really interesting. I mean, learning about tax lien investing, that's something that we haven't talked about on the show. So I want to thank you for just sharing your experience and knowledge on that subject. It sounds like a great opportunity you're offering to learn more about it through someone who's doing it and has been doing it for quite a while. Thanks so much for taking the time to be on the show today.
Well, thanks for having me. It's been a pleasure.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Point Central, the leading provider of enterprise-scale smart home automation for short and long-term rental property managers. Learn more at pointcentral.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.